Um, Hello. So welcome back to the continuing lecture in uh, investment analysis. So in our last session, um, we were cut off, basically right at the onset of the multi-factor APT, and we just kind of took a look at the setup of the model. And so basically, let's say we have identified two macroeconomic factors, right? That are, uh, and each of these macroeconomic factors have expected return of 10% and 12% respectively, and the risk-free rate is 4%. And obviously, uh, we have to operate with the we have to operate on excess returns or risk premium. So the first risk premium on the first factor uh, is then 6%, 10 minus 4, 6%. And the risk premium on the second factor is 8% because it's 12, it's 4. And our beta uh, the beta on the first factor is found to be 0.5, and the second uh, beta is 0.75. So of course, these are slope coefficients. So you run a multiple regression, multiple regret the regression with two explanatory variables, right? And it's been determined by regression. So you can think of it this way. I mean, of course, then our portfolio risk premium is basically, beta times the first factor risk premium and plus beta 2 times, second factor premium, premium, risk premium. And the whole and by now, you may have realized, the very, very basic and simple principle behind arbitrage pricing theory. Basically, which is that the arbitrage pricing model cannot work if there is no short sell. Isn't it right? It's basically, arbitrage idea behind arbitrage model is you short sell something, an asset or a portfolio, right, of assets in a market that is, underpriced, right? And then with the proceeds, from the short sale, you buy the assets in the portfolio in the market that where the pricing is it is overvalued. Again, Can that happen? I mean, um, uh, yes, of course. I mean, the thing is, we are short selling um the portfolios component for two component portfolios that are uh, that make up this uh, bigger portfolio, right? And then um, I mean, if there's you are short selling in a market uh, where these two portfolios are traded, right? And then with the proceeds from that short sale, you go long, you buy, right? You go long in a market uh, where uh, there's a trading of a large portfolio consisting of the assets that are uh, also components of portfolio one and portfolio two uh, that are traded separately in a uh, another market. I don't know how better it can be explained. I mean, um, it's a little different story and a little different example, but I like to. I've been using this example over and over. For example, suppose you went to a small town in upstate New York, and I mean this is once again a very hypothetical example because in reality, uh, uh, it cannot happen. It can. There's a with a very rare chance it may happen, but suppose I don't know if you ever ventured out of New York City, but if you go upstate, even like there's a town called Beacon in upstate, and a beautiful, beautiful town overlooking Hudson. Really, uh, and such which is in I believe in Dutchess County, or I mean it's like 1 hour by train or 1 hour, or probably 1 hour and 1 hour and a half by car if you take Metro North. um, so it's a beautiful town by Hassan, and there's also a museum. Um, a lot of people usually uh, on we a lot of people flock to that town on weekend trip by taking Metro North, a very wonderful train ride. But that's not the main point of the story. So you ventured out into that on a weekend trip. You went to Beacon, upstate New York, and you stopped by. You stepped into a Apple store. There must be Apple store there. I never checked, but I think it is about 2 hours away. From New York City, even by train or by car. Um, and in the Apple store, the only Apple store in that town, and in whatever there must be more Apple stores throughout the entire county, but it's very sparsely populated. If you actually go upstate, between each, townships, between each township, there's whole that whole lot of nature, vast wooded areas, just beautiful nature only. So in this town's Apple store, the only Apple store, um, you walked in and you found that you checked out some products, and you found that the the iPhone 10, found iPhone 10 was on display, but you couldn't believe your eyes because the price tag was saying $500. Now, I don't know exactly how much Apple iPhone 10 is, but let's say iPhone 10 is $1,000. But for some, by some fluke, the computer system, their computer system, um, uh, got fried up, or got hacked, or there was a uh, uh, system failure or whatever. So the price temporarily was offline, or misaligned. I mean, you know that, oh, in New York City, it's $1,000, but it's 500. That's the price, showing on their system, on their computer terminal. So what can you do? Um, um, but if that happens, isn't this an opportunity to buy? Clearly it is underpriced, right? And whatever is underpriced is a buy target, right? And you can normally what you think is, oh, you buy this there for $500, and then you bring it to New York City, sell it for 1,000, and you make $500 easy, right? This is but then this is not arbitrage, because you have to first make your own investment. You have to pay $500 out of your own pocket, and then you have to sell later in New York City for $1,000. So suppose you are reversing this. Of course, you might you might say, if I never venture out to Beacon, I would never know if it is, how do I know in advance that the price would be, like $500? That's why you have to. So normally, in normal circumstances, you would never know. And it's purely a happenstance. It's purely a happenstance that you stepped into the Apple store in the town, and you found that the price was 500. But if you're a security analyst, I mean, you do the research, and you try to find this mispriced asset. So if you're a security analyst, then I mean, if you're out on alpha hunting on iPhone, right? You would search far and wide for undervalued iPhone 10, and somehow online search or whatever, and somehow you found the store in upstate New York, in a town called Beacon, and in that Apple store, iPhone 10 is only $500. And what do? You basically short sell iPhone for $1,000, or $900 even. I mean, for $900, that means you tell people, you sell it before you have it. You sell and tell them, I'm gonna get your iPhone for $900, but you have to pay me money first. And if they trust you, they will pay you. If I at least know $900 or something, right? Because um, there should be an incentive for them to buy from you and pay in advance. So they pay $900. So you got money from 10 customers, that's $9,000, right? And you go to Beacon and go to the iPhone's Apple Store there and buy 10 iPhones for $500. So what just happened? You sold short 10 iPhones, right? At $900 each. So you didn't you financed your purchase of 10 iPhones, right? By short selling first. So you didn't you have already the money, right? And then you buy iPhone in Beacon for $500. So you made $4,000 in this deal, right? Without any of your money, right? With zero net investment. Make sense? I used iPhone as an example. So and because it is iPhone, it's really hardly uh, uh, it doesn't seem it's it's hardly going to happen, right? Because obviously Apple stores, no, you don't. Apple stores, it's not going to happen, right? They're all online, their system uh, unless their system fails, right? Um, this is not going to happen. Their prices will be all the same. But in reality, these things happen very often every day. Now, just go on eBay and check. Not the top of the line, latest model, but even for latest model on Amazon or on eBay, uh, you will find them all in different prices, right? So, I mean, let's say you're buying, like Galaxy iPhone 8 or Galaxy 8. iPhone 8 on Amazon or eBay, there are so many vendors, so many sellers, and they all have different prices. Of course, if they are like used or factory refurbished, the quality may not. I mean, there will be huge variance in quality. But let's say they are all unused new phones, just a surplus, right? Unsold surplus, so their qualities are all the same, all same quality, right? But then different sellers have different prices, and if you think you can take advantage of that, let's say uh, iPhone 8, one seller sells it for $600. Another seller sells it for $500, and you can arbitrage, right, between the two. Makes sense? You can, you take order from your buyer. Let's say uh, uh, you're telling them you're selling iPhone 8 for $600 to your um, customer, but you get paid in advance, okay? And then you find this, you buy from this seller on eBay uh, that phone for $500, and then you deliver it to your customer. Then this is arbitrage. In other words, there's a short sell first, and then long position, short and long. Short position happens first, and long position happens later, right? In other words, you're taking advantage of this, mispricing in the market. I mean, that's basically the principle behind arbitrage pricing model. Make sense? And whether it is single factor or multi-factor, right? The whole idea is So so you're buying, let's say on eBay iPhone 8. iPhone. I mean, this is this example gets weirder and weirder. But let's say you're buying iPhone. Uh, I don't know. This iPhone cannot extend. This example cannot extend. I mean, you're buying iPhone 10 by short selling two iPhone 8s or iPhone 8 and iPhone 9. I mean, uh, this cannot happen, right? Uh, but the example I used, the asset in the example I used was iPhone. So that would be uh, uh, that would not be a quite uh, uh, a practical. I mean, that would be a like correct model, correct example. But the what I'm saying is, if you can break down iPhones into components, right, and um, this is again um, two. You have and those components you can break down iPhone into like components that have like they can that can be also all traded at certain price, right? uh, and if you can break down iPhone 10 into iPhone 8 and iPhone 9, right? um, by short selling iPhone 8 and iPhone 9 and by buying iPhone 10, um, uh, basically you can deliver to your customer, right? uh, uh, with the product they want without actually making any investing without investing any of your money and completely risk free. Now that again, so back to the original point, there can be no arbitrage, right? Pricing if there is no if short sale is not allowed, right? Think about it. In a world there is no short sale, um, arbitrage cannot, uh, arbitrage model cannot work. But you get the idea now, right? So the whole idea is you're gonna have to, depending on, depending on uh, uh, what is the algebraic sign of alpha. If alpha is positive, then uh, you will short sell the component factors, right? The factors uh, that make up this model, and then you go long, you buy, the arbitrage portfolio. So in our model, so let's take a look at this again. So the portfolio risk premium will have to be first factor premium, which is 3%, and second factor risk premium, which is 6%. So it should be 9%. Then the expected return on this portfolio should be by adding the um, risk-free rate, right? Um, because this minus RF is this minus RF is risk premium, right? If you move RF to the other side, then this is going to be just the expected return on the portfolio. And then it should be 13%. And then expectations operator means, that's the expected return. Expected, in other words, it's the forecast. Okay. And for every forecast, there will be forecast error, right? Residual, right? So now let's take a look at uh, the rest of it. So suppose portfolio P has expected return of 11, expected risk premium of 11%. Now you might, what is this? I mean, don't wasn't risk premium on the portfolio 9%? Yes, but this is based on uh, our index model or capm, right? Or but this expected return risk expected risk premium on the portfolio is either calculated by the mean. I mean, remember when we the first model of regression of was basically I mean not the first model of regression, but when you took Finance 100, right? I don't know if in other classes you learned this, but um, in my classes, I basically the first thing you learn in risk and return topic is downloading data, Apple, right? And for the last past 5 years, monthly data, and it's all price data, basically price data. But we know how to calculate return, right? Return is monthly return is price at time t minus price at time t minus one, or price at time t minus one. Of course, we can use um, continuous compounding, right? But basically the discrete using discrete compounding, we just and it's just 1 month return. You do that for 60 data points, and you get 60 returns data, and then what is the expected return then? I mean, when you have 60 returns data point, how do you make a forecast of what's how do you make the forecast of what's going to be the return next month? Oh, once again, we have no better we have no better way to we have no better model for predicting that. I mean, at that point, than the average, right? The mean of the past returns uh, is the average of the past returns is the expected return. And I told you, expected return is the forecast. And although this uh, expected return may never actually occur, right? And I also talked about the uh, uh, a dice game, probability, a little bit of probability theory, right? You know, uh, dice game where um, you have a chance, only one chance of throwing a dice, and whatever number comes up, you win the dollar amount equal to the number that comes up. Then what is your expected payoff, right? And in that case, in Finance 100, everyone was saying, $6 or $1. And if I ask why, as someone who says $6, people will say $6 is actually, it's their wishful thinking. They want $6, they want the best result. But then where's the guarantee that six will come up, right? There's no guarantee. People who say $6 um, was just expressing their wishful thinking. And people who say $1 are basically, betting, like, uh, in the worst case scenario, even in the worst case scenario, right? There's no negative return. It's always a positive payoff because no number on a dice is less than one. So even in the worst case, they will still win $1. So that's why they were saying, and at least it cannot get worse than that, right? So I guess people who say $1 are more actually, risk averse and uh, in a way hedging very well. I mean, hedging their disappointment, right? Because um, if they hope for, if they wish for $6 and nothing like $6 come up, it will always be disappointment, right? But if your expectation is just, but that's not, uh, it's not expectation, right? Uh, uh, Anticipation or whatever you call it. I mean, uh, not if you're not betting on that high number, just $1, you will never be disappointed, right? Um, but anyway, the idea is the expected payoff is $3.5. Right, that's because that's the average of all the possible numbers that can come up, right? But think about it. Can 3.5 come up on a dice game? No, because it will never come up because that number doesn't exist on any dice, right? And if and even the past, no matter what you do, it has never come up. And in the next uh, cast of the dice, it will never come up either. But still, 3.5 is inevitably and invariably uh, the expected payoff, right? Uh, so just like that, the mean return from the past 60 months, this number may have never come up in the past, or it may never come up in the future, but still, it is the rationally expected payoff. And in that sense, this expected risk premium is either um, uh, the mean of all the past risk premiums for past 60 months, or it is something that is, in um, uh, something that is, expected by security market line. And then, of course, in equilibrium, the mean of these risk premiums and risk premium uh, forecasted by security market line are the same in equilibrium, right? So if that expected risk premium is 11%, now we know what alpha would be. Alpha is, then 2%, and it's positive alpha. So what do? You short sell these factor portfolios, right? The component portfolios, right? So if portfolio is well diversified, right? And we know this is going to be uh, if it is well diversified, we know expected error terms will be there's a name for that, white noise, right? Oh, give me a break. Okay, white noise. So uh, so here the summary of how to do that, constructing an arbitrage portfolio with two systematic factors, right? Since alpha is positive, then you short sell factor portfolio 1 and factor portfolio 2, and their betas were given like this, right, already, right? Their betas were given, right, 0.5, 0.75. And that's that's negative point, negative 0.15, right? I mean 0.125. Negative 0.1, I mean 1.25. So what do you do then? You short sell, 120, 50% of the portfolio value, and then you go long 100% on the portfolio, our arbitrage portfolio, and go long 25% on risk-free asset. Okay, so this is basically how it works, right? So that wraps up everything about the arbitrage pricing model, right? And that will be it for this topic. And I will see you guys in another topic if time allows. Okay. All right. Thank you for watching, and stop recording.